Hello, my friends. So we just had the June FOMC meeting, so this is my FOMC debrief. Now, before we get into what happened, let's level set a little bit. So today was a June meeting, and these quarterly meetings are special because we got a dot plot. Now, the last time we got a dot plot was in March, and at that time, the Fed guided towards 3 cuts this year. However, between then and now, inflation has not declined as expected. It's actually been pretty sticky. So Chair Powell a few weeks ago made it a point to tell the market that he's not happy with progress on inflation. So the market adjusted accordingly. Now this morning we got a CPI print. It was better than expected. And heading into this meeting then, the market was pricing in 2 cuts this year. Now the dot plot we got this time around, I think was pretty hawkish, and certainly much more hawkish than I expected. I was expecting, along with the market, 2 cuts to be priced in for the rest of the year. However, the June dot plot actually only has 1 cut, and in addition to that, a couple other changes were made as well. So first, the Fed revised its long-term neutral rate upwards from 2.6% to 2.8%. So the neutral rate is basically a standard by which the Fed judges how restrictive it is. So when policy is above the neutral rate, that means that the Fed is trying to slow down the economy. When policy is below the neutral rate, that means the Fed is being accommodative and giving a tailwind to growth and inflation. Now, by revising upwards the neutral rate from 2.6 to 2.8%, the Fed is saying that, actually, I'm not as restrictive as I thought, and which might be why they're only projecting 1 cut this year, simply because it seems like the economy is more resistant to interest rates than they previously thought. Now, to be clear, when you look at the market is pricing in a neutral rate about 3.8%. And so the Fed is, I think 2.8% is still far below the market and far below my personal expectations of where the neutral rate will be. But slowly, though, over the past few meetings, the Fed has been revising that upwards. Now, the second thing that they changed that I thought was noteworthy was they revised the the long-term unemployment rate upwards from 4.1% to 4.2%. Now, I think this is pretty hawkish as well. Now, the way that the central banks look at monetary policy, they usually view it as having a trade-off between employment and inflation. So, for example, the Fed could hike rates significantly, slow the economy down, and get inflation under control, but the side effect to that would be higher unemployment. Now, today, the unemployment rate is 4%. Now, by revising up the Fed's perceived long-term unemployment rate to 4.2%, that means the Fed thinks that there's still some room unemployment can rise before we get to that part where the trade-offs become harder. Because right now, unemployment rate is still below where they think the long-term unemployment rate would be. So, all in all, I thought this was a hawkish dot plot. Now, what surprised me, though, is that the market didn't really seem to care. Now, usually, with this kind of a hawkish gesture, we would expect that the equity market to sell off, and we would expect interest rates to rise. But we didn't really see any of that. I think towards the end of the session, we got some declines in equity markets, and it looks like the interest rates rose a little bit, but it wasn't a very strong reaction. So I'm getting the sense that the market is not placing too much weight on the dot plot and is thinking that the data would change and the Fed would change as well, and maybe the market has its own view on data. Now, to be clear, as Chair Powell noted, now the dot plot reflects data up to this morning, so the good CPI print is also incorporated. During the press conference, I thought it was not too interesting. The Chair Powell seemed a bit flustered. I didn't get the sense that there was a very coherent message. His message that I thought that stood out the most to me was, if you want rate cuts, two paths, same thing he said last time. We need to have more confidence on inflation coming towards 2% target, or we have an unexpected loosening of the labor market, which, as I've been writing, is my expectation. One interesting thing from the press conference was a reporter asking Chair Powell, basically, what would happen if you cut rates one time? Why don't you just cut it? Let's listen to his reaction.
A lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
So that's not how we look at it. Really the whole rate path matters. And I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know.
Basically, Chair Powell was saying that, if I cut rates, everything will surge. We're going to crash up. And, I got to be careful when I do that. But the thing is, I think everything is surging in anticipation of your first cut. And when you actually cut, maybe things accelerate. All right, so that's what I have to say about the FOMC press conference. Surprisingly, I think hawkish, but also surprisingly not that influential on markets today. All right, talk to you all this weekend.